for today's 104th webinar on unlocking value through M&A and restructuring. Thank you all for joining in our journey and encouraging and motivating us in our knowledge sharing initiative. Friends, M&A and corporate restructuring has gained substantial steam in past 2 decades in the world of business. Corporate restructuring is an inorganic business strategy where one or more aspects of business are restructured to drive various benefits such as economics of scale and improved commercial efficiency, increased market share and market level of competition, drive faster pace of growth, effective utilization of resources, tax benefits, and fulfillment of stakeholders' expectation. Friends, demerger and hiving off of different nature of business is also a very popular tool amongst corporate to unlock the value of business. Corporate restructuring serves different purpose for different companies at different point of time, and many take up various forms. One plan cannot fit in all the cases. Every company, every design, everything separate. So today, the companies may consider such form of restructuring which unlock the value of its business. Key area of discussion during the webinar will be various types of corporate restructuring, how to enhance business value through M&A, leaning out of business, because what is happening, you have formed various company and you have formed various company for various purpose. But today the purpose is fulfilled and that is not required. But the company, the structure is still with you. Unlocking the value through hive off and demerger. Various business benefit, tax benefit and stamp duty implication, valuation aspects in M&A, procedural aspects and regulatory hurdles, Q&A and from the participation. This is the structure which we will discuss today, and we have invited various eminent speakers, those who are expert in this area, because the M&A transaction and then its implementation requires multiple law. It requires company law, it requires SEBI law, it requires valuation aspects, it requires CCI approval, it requires stamp duties aspects, it requires RBI approval, it requires income tax approval, it requires NCLT. So various agencies and various organizations are involved in this. And when you are making a plan, the most important is that what you are planning something. The planning is the implementation, and that is in future, if you are making a plan in such a manner that it will not affect your future journey, then you have to think properly, plan accordingly, and then implement smoothly. So this is the mantra of when you do the corporate restructuring. Today we have eminent speakers for today's webinar, Mr. Rajiv Chaube, Senior Executive Director and Group Counsel, Group GC of Dalmia Bharat. Prior to Dalmia Bharat, he was working at Ambuja Cement as Chief Legal Officer. He has experience of more than 25 years and held leadership positions in several organizations, and he was a part of various M&A transactions. We welcome you, Rajiv. Mr. Manoj Kumar, partner and head of corporate professional, and he is a prolific speaker, and his quote and comments are regularly carried in major financial dailies, e-papers and business magazines. So he will discuss about the M&A, what are the issues and how to handle this. And Manoj has undertaken more than 250 listed and unlisted companies M&A, and he has advised so many companies also. Ms. Ruchika Sharma, Associate Partner, Corporate Professional. She possesses over 7-year experience specializing in transaction advisory for various deal, transaction and acquisition of listed companies. She played a significant role in managing highest number of takeover open offer dealt with her by firm in the year 2015-16, and every year she is handling around 10 and takeover offers. We welcome you, Ruchika. Then we have Mr. Sanchit Vijay, is the Director of Corporate Professional, and he's head of Deal and Business Valuation Services. Earlier, he served as an associate consultant in Infosys and equity research analysis at Capgrow. He has co-authored CP's research publication and written article which has been published in the journal, online portal and business magazine. I welcome Sanchit. Then we have Suman Kumar Jha, law graduate, member of ICSI, possessed earlier 8 years experience in corporate restructuring and corporate legal matters. He managed merger and transaction advisory of various listed and unlisted companies, helps his team in preparation of different type of complex and composite scheme of arrangement. He is member of Bar Council of Delhi and regularly appearing before NCLT for M&A transaction in various NCLTs in India. So friends, today we all, those who are experienced in this area and those who are day and night working in this area, they will tell us what are the M&A transactions and how we should handle it. So the transaction, the entire discussion we will take up like this. We have a regulatory aspect, stamp duty aspects, valuation aspects. So first, Manoj will start real trend in M&A, how the value creation can take place from merger, demerger, and slump sale. The Manoj will take up, and then Ruchika will take up takeover. How the acquisition can take place through the takeover route, and in case there is a takeover and then merger, or somebody wants to do merger, because earlier merger was allowed directly, you can do and you can avoid takeover regulation, but now they are not allowing. So Ruchika will tell us how you can take over the company and then merge the company. Then valuation aspects, what are the M&A transactions, because every M&A transaction requires valuation now, and the SEBI is putting more and more condition and more restriction on this. So what are the role model, what are the method, what types of challenges when you do valuation of M&A, that we will discuss, and listed companies, M&As, and other aspects which we have to understand. Then we'll discuss what are the issues you are facing in NCLT when you are designing your scheme, what are the points which you should take care. And then we will request Rajiv Chaubey to give industry aspects, that what are the point of view when you do structuring M&A, what points you should take up and what points you should take care. And after that, we will have question answer. So anybody who has any question, please write to us. We will give a reply to you. And today we are organizing this 104th program. And I just want to share that today Corporate Professional has completed 19 years. And today we had our anniversary. So that is a very good coincidence that we are having the program on our anniversary day. We have completed 19 days. Thanks to all our clients, all our friends, all our associates, and the special thanks to our team who has given this, and those who have part of the CP earlier, they have for the growth of corporate professional, they were also the pillar. So I thank everybody, every client, every associate, and every person who has contributed in the growth of CP. So thank you very much. Now I will request Manoj to take up this aspects of M&A, recent trend, and how the value creation can take place from merger, demerger, and slump sale. Over to you, Manoj.
Thank you, sir. Good evening, everyone. Good evening, my co-panelists. So it's a very popular and very important topic, M&A transaction, through which corporate can unlock its value or enhance its value. So we all know that these are M&As are basically inorganic growth plans, growth plan for any corporate organization, and it happens a few times in the whole corporate life of an organization. But it is very important. It has many aspects. So everything contributes to the success of any M&A transaction. General study, everyone knows that this is done for, let's say, backward or forward integration of any business, so that growth can happen, margins can be improved. Then it can happen, it will help in market share improvement or elimination of certain competition. It may also help in geographical expansion or creating presence in any strategic location for any organization, which might help in reducing the cost or enhancing the value, or let's say import, export, making it easier. So these can be things. then it will help in unlocking the value through demergers. Certain, there may be two or more type of businesses under one roof which are not getting the real value in the market. So if they are separated, it can unlock the value. Then there may be aspects of tax planning. There are many stressed companies or a company under insolvency which is acquired to take advantage of tax benefits or to take advantage of the stress situation, which may add to the value of existing profitable companies. So there may be many aspects, and merger and acquisitions has a lot, very type of things. So we will discuss what trends are going on. Like everyone knows that last 2 years, since 2020, the pandemic has hit. There has been disruption in the business, but after that, as the impact of COVID is reducing, Indian M&A transactions are improving very fast. So we will discuss the trend and then what are the major things. So let me share my presentation and we will discuss from here. So we can see that M&A transactions in India is increasing very fast. Any M&A transaction or starts with the funding aspect. So PE funding has seen very high growth, and we are now, in comparison to China, we are more liked state. So that is one indicator that there is a confidence in the Indian market. Then there has been a all-time high M&A transaction in value term, which is around $148 billion in first 9 months of year 2022. There has been a growth of around 58% during from 21. So this is a very good sign. Then in percentage term, domestic M&A transaction has also been very high. It is around $105 billion, which is very high for Indian sector. Then if we see sector-specific M&A transactions, so in value term, financial service sector has been the leader, and it around $70 billion fund transactions has happened in this year, which is around 300% jump. If we talk about the number of transactions, the technology sector has seen a lot of transactions. So number is very high, but the percentage in value term, it is around 12.5%. So if we see in what kind of sectors have contributed to the total M&A counts, in 2021, the biggest size was e-commerce, which is now enterprise technology. So enterprise technology solutions, because due to COVID, many of the organizations have shifted towards e-platforms, work from home. So this has led to enterprise technology, and it is a type of disruption which has created through this. So e-commerce and edtech and fintech contributes around 44% of total M&A transaction during this year, 9 months. And then if we see, we have seen the growth of the startups ecosystem in India. It has grown very fast, and in year 2022, around 200 to 29 deals has already happened in the M&A, this startup ecosystem. Here again, enterprise tech is the biggest M&A contributor. Number of M&A transaction has happened. We have seen that Indian startup ecosystem has improved very fast, and its size is now around $42 billion, which has around 1,584 deals in 2021, and India has produced around 42 unicorn this year, so which is highest ever. We can see a few well-known names of startups which has now become a giant. If we talk about M&A strategies, so we can broadly divide the M&A strategies in 3 parts. One is acquisitions or takeovers. Acquisition or takeover refers to a transaction where the two companies continue in existence, but their control is taken over by one another. So it creates a holding subsidiary structure, and it helps in consolidation of the share, keeping the entity alive. The other one is the mergers and amalgamation, where two company gets consolidated, and entity of one of them is gone. So only one entity remain after the amalgamation. The third type of major type of strategy is the slump sale or hive off or demerger. So slump sale and hive off is a private transaction where one division is sold to another company, which may be subsidiary, which may be a non-subsidiary outside the group. Anything it can happen. And demerger is the transaction where company is vertically split and both the company remain in. It may be an existing company which acquires through a court-run process similar to merger amalgamation. So if we talk about the merger amalgamation and consolidation, we see the major reasons for which such type of transaction is done. One is the economy of scale, then creating some synergy benefits, increasing the market share of entity, removing competition or creating a competition, making the company more competitive, then access to talents which is not available with the company. There may be a situation where diversification of risk is one of the strategy for this. Then faster growth strategy, one of the faster growth strategy or inorganic growth strategy is consolidation of similar line of businesses. Then there may be circumstances where tax benefits could be the leading reason for any M&A transaction. So these are the major reasons for merger or amalgamation transactions. One trend we have seen recently is that many of the corporate houses which have several entities within the group are now consolidating their businesses or reducing the number of the entities within the group. There was a time when there was a license requirement for many of the businesses or manufacturing setups. There were restrictions in the business, so separate entities were created. But as the economy has now liberalized, the existence of multiple organizations within the group is not feasible, not economically viable, or it is creating unnecessary hurdle or defocus the management. So we have seen many of the cases where hundreds of companies, 50 companies, 30 companies are consolidated into one company in one or more branches. And later on, there may be a situation where unconnected business is demerged from the consolidated entity. So this is also one of the trend. So this also helps in minimizing the managerial effort, reduces the cost, and also make the organization lean and agile. So that is also one of the very important strategy which is being followed. Recently, we have seen many mergers, amalgamation within the group, outside the group, like tire companies got consolidated under JK Tire, or let's say GTV and Sony Pictures are getting merged. Now Sony becomes a listed company with G as well as Sony's business. Tata Motor and Ford. We have seen several other M&As in the space of distressed companies like Tata Steel acquired Bhushan Steel and then later on merged into it. Then JSW acquired Monet Ispat and consolidated the two. Now a scheme is pending before SEBI. So these are the transactions which will substantially increase the size and business of the company. So help in inorganically grow. And it will also remove the company which are not viable from the system, and obviously increases the value of the running profitable and better managed company. So these are the very important strategies which is being followed and which is helping to unlock the value of the businesses. Then if we are talking demerger or slump sale or hiving off of the companies, which has also many of the benefits, like it helps to focus on core business competencies. So non-core business is separated, and sometimes it is sold to third party, which might be having good strength in that sector. Or maybe management may make two separate verticals, separate structure within the group. So, and there can be professional management to run the two businesses separately. Demerger could also help in tax planning if we can have the benefit of the 72A to take the carry forward losses of one of the business which can be consolidated and taken advantage of. Then it is generally seen that when two unconnected businesses run within one umbrella, it is not getting the right value, because if it is a listed company, because listed companies are basically perceived by separate different investor groups, considering their industry. So there are industry specific investors, and there is industry specific PE multiples or price earning multiples based on their valuations are perceived in the market. So if, let's say, two unconnected businesses are there, there is always a confusion which industry, which sector investor would prefer that company, and what multiples should be given to those companies. So benchmarking will become very difficult. In such circumstances, if we separate those two entities, two businesses, it will unlock the value, it will enhance the value, and the investors would be substantially benefited from the same. So we have recently seen that many of the cases, one of the cases like Adani Enterprises, which is having multiple businesses, have separated their renewable energy business, and it has become a separately listed company. So Adani Energy, similar transactions like Anant Raj Limited was a company, a real estate company in Delhi, which has got merged and divided into two parts. Both the companies now are listed, and it has substantially unlocked the value. So market cap has gone maybe around 5 times since their demerger announcement. Similarly, Jubilant Pharmova, Jubilant Life Sciences was a company which is having formulation as well as API business. So they have demerged the API business into a separate company, which is Jubilant Life Sciences Ingravia, and Jubilant Pharmova is a separate company which is continuing as a generic drug company. So both the company post demerger, I think more than their value has unlocked, and now it is around 3 times the base value at that time. Obviously, there may be several other factors, but these are the major things. Similar, we have seen similar kind of transaction in Vikas Ecotech or Sibley, or there are many other companies which are the examples. Like Sharda Motor has recently demerged and separated its division. Then Dhampur Sugar has separated the bio-organic business to another company, and it is also a listed company. So these are the transactions which have helped in unlocking the value. There may be regions which are different for different organizations, but it gives benefit if it is a listed company to all the shareholders, all the investors of the company, and certainly there has been unlocking of value in most of the cases. So if another strategy is acquisitions and takeover, I think for that we will Ruchika would put more time on this and give detailed process and requirements. Over to you. I think Ruchika, you can take up from here. Thank you.
So Manoj, thank you very much. I think Ruchika can cover that acquisition when you are doing. Then acquisition is not only required various technical aspects, but legal aspects also. So for listed company, takeover law is the main law where you have to follow. Over to you, Ruchika.
Thank you, sir. Thank you, Manoj sir, for giving the brief introduction about the value creation, which generally is created by doing the M&A strategies, which all the companies are being followed, and all the companies have been following, and all the people generally follow. So coming to the acquisition and takeover part, I would like to just add here that for any company who has been doing business, if they want to reach to the next level of business, they have to do expansion. And as Manoj sir has rightly pointed out, there are only 2 ways of expanding. Either you set up a business organically, you take approval, buy the land, you set the factory, you put all the equipments, you take various approvals from the respective ministries, authorities, government agencies, and then you start the business. It takes 3 to 5 years to start a business by this way, by this manner. And the other manner which is prominently followed and which is available is acquiring any business in which you are interested, which is already there in existence. So you see, in the market, there are always some set of buyers and there are always some set of sellers. There are some businesses who want to focus on their core areas, and they want to hive off some of their non-profitable businesses or businesses where they do not want to focus. So these transactions of acquisition and takeover are consummated and completed when these two parties meet, and when their synergies, their expectations, what the buyer is looking for and what the seller has to offer meets. So this is the background based upon which we are discussing the acquisitions and takeover. And as rightly pointed out by Manoj sir, there can be a possibility that not in every acquisition and takeover transaction we consolidate the company at the end. So there can be a person there can be an entity or a person who can acquire a company, and thereupon that entity doesn't merge into this entity, and both the entity runs their separate business even after acquisition. They can be in holding subsidiary structure, they can be in a wholly owned structure. So this way the transactions are generally completed. And we have seen a lot of cases. As I was going through some data, I've seen in financial year 2021 there were around 600 M&A transactions which has been completed in such a way, by only acquisitions and takeover, not by going into the core mergers transaction and the demerger transaction. So now coming out on the acquisition part, see, the process of acquiring any company is you have to understand there are two set of companies in businesses. One is an unlisted set of company, other is listed set of company, other is unlisted. But for both the set of companies, the broad process of initiating the negotiation or coming out at an arrangement where both the parties can join hands and work together is more or less same. So initially, there is a buyer who has certain requirements. They want to acquire some sort of business or some sort of company. They roll out their requirement, and there is a seller who want to sell their business, and both the parties meet and they arrive at a basic terms. They lay down basic terms, which we call in our technical term is the term sheet. They come and they agree on basic terms. Based upon those agreed terms, the buyer or the consultant of buyer carries all type of diligence of the target entity. It can be financial diligence of the financial, historical financial data, and can be of the future projections also, how this company will perform if the buyer will infuse funds. And the diligence can be on legal side. The diligence can be on the certificates and the all the approvals that target company has to do various sort of businesses. And it can be it can be of taxation, it can be of the specific plant and machinery being acquired. So all these sort of diligence are being carried, and once the diligence is there on table and the buyer is satisfied of what all things, what all requirements he was looking for, and he has gotten that target company, then they move on to the next level where they agree upon the valuation, which we will critically discuss in a later part of the discussion today, which will be discussed by Mr. Sanchit Vijay. So then the transactions go to the valuation part, and on the basis of valuation, which is justifiable and which is agreed to both the parties, they further enter into a final share purchase agreement or a share subscription agreement, as the case may be. There can be various modes of doing it. And once that share purchase agreement is entered, thereupon the other level is triggered. So, you see, there can be various type of companies, various types of businesses, and where a lot of regulatory approvals may trigger upon entering into share purchase agreement. So if we talk about any NBFC, non-banking financing company, there can be RBI approval, which would be required to consummate the transaction. If we talk, let's say, if the buyer is a foreigner or a foreign entity, then there can be certain approvals from the department DPIIT for the investment in that particular sector. There are thresholds. Some are under automatic route, some are under approval route. So certain approvals can be required. If the transaction is very big in nature, and so might be there are chances that you have to approach to CCI, Competition Commission of India, to seek their approval. So not merely upon entering into a share purchase agreement, you complete the transaction. That can be done in simpler, smaller transactions, but wherever the government approval is required, that has to be procured, and post receipt of that approval, the transaction can be consummated. Now, this is the general process of acquiring any company, of acquiring any, any listed or unlisted company. When we talk specifically about listed company, as we all know, SEBI is the capital market regulator for listed company, and whenever there are some thresholds defined under SEBI takeover regulations of 2011, whereby if those thresholds are triggered, then you have to follow the process of takeover open offer before acquiring those percentage stake in that company. So you see, if I talk about listed company, then to acquire the threshold, to acquire those percentage of threshold or control in that listed company, you have to follow the approval process, or you have to seek approval, file the offer documents and everything with SEBI to proceed further for acquisition of those stake or controlling position in the listed company. So broadly, the process of takeover is that you first enter into share purchase agreement. Manoj sir, can you please take to the next slide? Yeah. So firstly, you enter into the share purchase agreement or share subscription agreement, or there can be various modes of triggering the transaction. It can be by entering into SPA to acquire shares. It can be by subscribing to the fresh shares. So there can be various modes. You trigger the transaction, then you have to make public announcement as per SEBI takeover regulations on the same day, or in some cases, there are some timelines for the very next day. You have to do that public announcement. That's a 4-page short document as prescribed by SEBI, which provides the broad terms of what you are acquiring, at what price you are acquiring, who is acquiring, that all things are captured there. Once the PA is out, the acquirer has to infuse funds in the escrow account, which is opened by acquirer for the public shareholders of that listed companies. So you see, as we all know, as per SCR regulation, there shall be at least 25% public shareholders in every listed company. So the takeover regulatory advisory committee, while forming takeover regulations initially in 1997 and then 2011, ensured that whenever there is any change in control or change in management of a listed company, there shall be an option or a right or an exit opportunity given to the public shareholder, whether they want to acquire their shares, so that they can have that option whether they want to continue with the new management or they want to take exit as the old management is exiting. So that interest is protected. So fair exit opportunity need to be given, for which the open offer has to be made, and the escrow account shall be, the acquirer has to add funds in the escrow account as per the threshold provided, which is 25% in general. And once the funds are infused to ensure the interest of those investors, the detailed public statement is being made. So the DPS, which is detailed public statement, comes after 5 working days of the public announcement. And in that detailed public statement, as I already mentioned, in public announcement, the acquirer initially tells about his entity, himself, and what stake they are acquiring at what price. But in the detailed public statement, they tell entire object of acquisition, that why they are acquiring, what business they want to continue, and whether they want to continue the business or they want to change the business, and who would be the board structure post to the acquisition. So all those things are captured in the detailed public statement. Once the DPS is published in the newspaper, thereafter the next stage detailed document of more than 50 pages is filed with SEBI, which is the draft letter of offer. And that draft letter of offer is taken by the SEBI officers to analyze the transaction, to understand what is the transaction, to check the past non-compliances of the promoters who are exiting, because once they would take exit, SEBI would be in a tough position to find those promoters. So at this stage only, they check all the non-compliances of the past promoters, and they take actions if required, and all other nuances are being checked by SEBI. So SEBI generally takes time of around 15 to 20 working days to give their comments on the draft letter of offer. And once the draft letter of offer is approved, thereafter the process for opening of tendering period is is generally starts. But before going to the opening process and the process where public shareholders can tender and can sell their shares, there is also an opportunity of making a competing offer in between. So this competing offer period is a period which is open from the date of DPS for 15 working days. And in this period, any other acquirer who is or who might be interested in acquiring this company, or maybe counter offer can be given by the promoters itself if it is a hostile transaction. So they can come out with an open offer for a certain number of shares at some different price. So that is also one of the way to to block the transactions also, or to make it more competitive. So then again, the process, if competing offer is not made within 15 days, which we have also seen in last 10 years, I recall there was only 1 or 2 transaction where we have seen that competing offer was made. So this is very rare to happen. So in general process, we receive the comments of SEBI, and once the SEBI comments are received, then the acquirer has to dispatch the letter of offer to all the shareholders. Shareholders get time of around 5 working days to analyze the letter of offer, to understand whether tendering in this open offer would be beneficial for them, or they can, as a merchant banker, we also receive call from various shareholders. When they see offer price, they tend to have an interest to tender, but then again they are so inquisitive and they ask about what business the acquirer will start and how the company can grow. So they take their right decision on the basis of information which are there in the letter of offer. And then the tendering period of 10 working days starts, and the shareholders tender or may not tender in that tendering period. And once, if they tendered and if the bids are accepted, then the payment has to be made by acquirer. So once this process is completed, in general cases, once this process is completed, the SPA transaction, which I was talking about just before coming to this legal process, can be consummated, but only in some exceptional situations where you require any regulatory approval, or where any approval is pending, because there is a provision in SEBI takeover regulation which says that the consummation of the triggering transaction or completion of the transaction cannot be done unless all statutory approvals which are required for that transaction have been procured by the acquirer. So the acquirer cannot start the business in the company, the acquirer cannot change board, they have to wait for that much period till when they will receive the regulatory approvals. And so this is the overall legal process of acquiring a company. And once the acquisition is, let us say, once the approvals are received and acquisition is completed, then the normal closing actions take place in any business doing company. There are set of employees, there are set of various things which need to be shifted to acquirer. At times the acquirer and the sellers are not in same state, so they have to do a lot of closing actions and things which are generally we don't get to know in our legal process. But as we have been part of some of the transactions, we have seen there are a lot of things they have to follow to complete those transactions. So this is one of the mode where you need not to consolidate the business in all the scenarios. But obviously we have also seen in a lot of transactions that after acquiring a listed companies, the acquirer has merged their business in the listed companies. So that is also one. There are strategies of creating the value. So you are running a listed company, you are doing business there, you have a value in market, you have a you get a valuation of your share, and then you acquire another listed company, you hold 50%, more than 50% there, you run business there, and you have value in that business also. So two separate listed vehicles are also created, and businesses can also be done in this mode of acquisition. And if the promoter are willing to merge them, then they have to follow the entire process of merger or demerger, as the case may be, as we'll discuss in the later part of the presentation, which is again a 8 to 12 months process. So that is broadly all about acquisition and transaction from my side, sir. Thank you.
Okay. Thank you, Ruchika. Thank you very much for explaining this aspect. Manoj, before going to the valuation aspects, I just want to understand, you have mentioned leaning out. Now, leaning out, every company, especially the real estate group or various group, they found various companies. So one group has 10 company, 20 company, 30 company, and every company, whether it's a no business or business company or less business, they have to follow all compliances. And there are so many people, those who have a listed company also, but there's no business in this. What is your suggestion to them? How to do leaning out? Because cost of compliance is becoming high, number one. Number two, when you are having this type of company, then you are bound to miss out some compliances and the penalty is huge. So what is your suggestion for those who are having multiple companies? Because sometimes what is happening, they are also not interested to keep, but some problem or other. So what are the problems you have faced in these types of company when the promoter is coming and talking? They are talking that I want to reduce, but some hindrance are there. So what are their hindrance?
So yeah, sir. So it is one of the very, very common thought of management these days. Earlier, many of the groups have several companies. Reasons were different. Like in case of real estate companies, there were land ceiling law, which required the company to hold not more than 12 acres of land. So they have created, let's say they have to acquire 50-acre land. They have created 5 companies and divided those land into those companies. And later on, project company has acquired development rights, and then property got transferred through development right, and company continues. So without any business or anything. So similarly, in case of manufacturing, also earlier licenses were given for a specific purpose. So several companies are created within the group to have different licenses, or there were restrictions that same company cannot have 2 mining license or 2 certain kind of license, manufacturing license. So these were the reasons why every separate companies were created. But now that time has gone. There are also many old groups which have created over the period. Many various companies, various joint ventures were created, which have gone. The joint venture time has lapsed. So all such companies are there in the group, and they are continuing to absorb a lot of time and effort of the management. And it is also obviously causing fear of non-compliances, taking out many of the resources of the company group. So these are the reasons, and it is better to consolidate those companies or close those companies. So for closing, we all know that demerger, closing of a company is not an easy process. If there is a asset or there is a business into a company, the company cannot be struck off or closed easily. If we go for the voluntary liquidation, it is still a long drawn process of maybe minimum 6 months. The standard timeline is around 1.5 years, or some in most of the cases, if there are businesses or assets in the company. So that is also not a possibility. So recently, we have seen many of the promoters are coming and they want to consolidate the company, but they fear that if we go with, let's say, 20 companies, and there will be some regulatory scrutiny during the merger process. So they fear that. Then there are stamp duty laws, and if the companies are in different states, there can be multiple stamp duty liability, which may look like very huge cost, and they feel that it is better let the company continue in such a manner. But my suggestion is to not to look for one-time cost of amalgamation, stamp duty, etc. If we are consolidating all the companies, there we can save a lot of time, effort, and energy of the group, and then it will certainly be. These benefits will certainly be much more than the cost of a stamp duty. There will be advantage of, let's say, some losses are there. You can take that advantage. If you have, let's say, authorized capitals of all the companies are consolidated easily without any cost. So that can be useful for the company which is doing business in the next round of capital expansion. Then consolidation would also create a larger entity. Financial strength will improve, which will help in raising the funds, raising further capital. If all such companies are consolidated into one company, it will also help to unlock the value for the management. If there are cross holdings, which will go cancelled under the scheme, and all the shares would come to the individual promoters, which will also help them to unlock their personal wealth. So I think we have to look into the cases, and with most of the cases, leaning out is a very good proposition, and we should explore the possibility. Regulatory process and regulatory hurdles can be left to the consultants like us, and we can manage those things. So I think that should be the good strategy.
Okay, Manoj, so this is the only fear is that payment is upfront and the benefit is in future. So that's why people are not doing this type of thing. Any solution for this? Like I have to pay stability.
Like I already told that this cost may not be very high. There are strategies, like there are states which do not charge any stamp duty. So we may shift the registered office there and then consolidate. So that kind of a strategy can be looked into at the time of making the plan. So planning need to be done at proper manner. We can save the cost, and still those expenses like stamp duty expenses are allowable expense under income tax. It can be amortized over a period of 5 years. So the running company can take advantage of taking that cost, and it will not be a loss, direct loss anyway.
Okay. Let me just when question answer will come, I will ask some more questions.
Yes.
Okay, now, as you are aware that today M&A transactions are very important, but M&A transactions require valuation, because every time one company is merging with other company is merging with this, what is the value of both the company, whether you are doing right, and specifically in the listed company, SEBI is very, very strict on this part, that when you are doing, we have seen in PNB Housing, we have seen in various companies, the SEBI is putting, and every time SEBI is making more and more stringent law, and they are just thinking that if you are doing merger, it is not an enrichment of the promoter at the cost of minority shareholder. So they are always bothering about this and understanding. So now the best aspect is to do the valuation, and they are giving, every time they are giving new dimension, new direction, and new suggestions relating to valuation. So now over to you, Sanchit. For M&A transaction, what is the role, method, and challenges we are facing?
Thank you so much, sir. So before I start, so valuation rests a lot on prevailing market condition. Changes in valuation may occur due to certain types of companies being in greater demand, or due to some sectors being perceived to be more attractive by the equity investing companies. So we do valuation in M&A for various reasons. There are lots of purpose. Let's say for determining the worth of the company, for any potential investment opportunity that may come, for creation any internal market wealth for the shareholders, issuance of equity and further equity for the shareholders, for taxation and regulatory purpose, the terms of the acquisition and negotiation, and corporate restructuring. So these are certain areas on why valuation is an important aspect that is to be covered. From this standpoint, I would like to let all the listeners know about the valuation approaches that we follow. They are broadly categorized into 3 approaches: income approach, asset-based approach, and market-based approach. The other approaches are basically a subset of these itself. The income-based approach is a capitalization of earning method and a discounted cash flow method. So when I talk about the capitalization of cash flow method and earning method, it is often used when a company is expected to have a relatively stable level of margins and growth in future. When I talk about the discounted cash flow, it is basically used when future growth rates of margins are expected to vary, or when modeling the impact of any future debt repayments to be done and calculating the terminal value. These are the 2 broadly income approaches that we use. When it comes to the asset-based approach, this is basically a method which is used to value a business on the basis of difference between the fair market value of its assets and the liabilities. So under this method, the assets are adjusted from the book value to the fair market value, and the total adjusted assets are then reduced by the recorded and unrecorded liabilities. A few approaches in the asset-based methodologies are the book value method, the liquidation, and replacement value. In the market-based approach, we look at the valuation from the perspective of pricing of comparable assets and making any proper adjustments for the difference in the size, the diversification of the business, and all of that. It is broadly divided into the comparable company method called CCM and comparable transaction method. The CCM entails valuation from companies that are being traded publicly, which are considered to be rightly similar to our subject entity. In most situations, the direct comparability is very hard to attain, since a majority of the public companies are not only larger in size, but also very diversified and dissimilar to the subject. So certain adjustments in the premium, the discounting, the multiple have to be made while doing a CCM methodology. Comparable transaction method involves deriving the value of our subject using the pricing multiple that are based on the observed transaction in the past few years in the industry. So it is sort of based on the perception of the comprehensive company financial data, and which are usually not easily available. But that is what the broad perspective in while doing the valuation using a CTM based approach. There are other approaches also, the rule of thumb, venture capitalist, first Chicago, price of recent investment, contingent claim. So these approaches are sort of a part of the income, asset, and market-based approach, but the methodology is slightly different. The major factor that I would like to highlight here are that contribute to the company valuation in any M&A transaction. These are broadly categorized into 7 factors that we have classified here. So let's talk about each one of them. The first one being asset. So in its simplest form, an asset-based valuation requires adding up all of the company's asset and subtracting all the liabilities. It is usually most applicable in companies which are asset rich and stable in its operation. I would say it is notable to mention here that whenever doing an asset-based valuation, we don't take into account the future earning potential of any company. It's only the material worth of the company's asset reduced by the liabilities, which is a simple yet effective way to gauge the value. When I talk about EBITDA as a factor, it is a measure of the financial performance of the company, which can be compared with other similar companies, which while excluding the various effect of corporate taxation, capital expenditure, and financial working, and a multiple is then applied to arrive at a valuation. The revenue multiple. It is actually the most quickest form of method we use in M&A to value a company, and can be a useful metric when comparing companies with different profit levels, but similar characteristics in terms of, let's say, margin, growth, products, competition. We usually use revenue sort of multiple in technology companies because if you look the valuation, they are not really profit generating. They lack profit, but the true profit earning potential is usually in the future years. There is one more argument in favor of revenue multiple is that revenues are less impacted by the accounting policies than earning or the profit based valuation. The another factor is the PE ratio. This is a ratio that expresses a company's share price divided by the after-tax profit actually, and it helps the buyer, both buyer and seller, to compare a company with its competitor. While an EBITDA-based valuation and a PE-based ratio valuation has certain similarities, but the way an EBITDA multiple and PE ratio valuation is arrived at is a little different. Dividend yield, I would say, is similar to the discounted cash flow. However, this yield gauges the present value of future dividend, which is the dividend, to prove the worth of the company. That is, the market value of the company is supported by the present value of its future dividend to the today's value. This is usually not very suited to valuing any company on its entirety, but can be a very useful methodology while valuation of any minority stake. Uh, Entry cost in any company valuation factor is basically an alternative to acquiring an existing company or a takeover, which and starting a similar venture from scratch. It could be considered sort of like an entry cost valuation that would include the cost of raising the finance, the purchasing asset, the renting of the suitable property, the marketing, building the customer base, recruiting and training the employees, all of these factors. However, this methodology usually doesn't hold any goodwill premium to it, or any established competitor which would have built up over the number of years. The precedent analysis, if I talk about, is comparable to the cost valuation and the precedent prices or transactions that have happened in the past M&A deals. These are certain factors that we have to always keep in mind while doing a company valuation in any M&A or restructuring transaction. I'm trying to tell you about the valuation and the life cycle of any M&A that we do. Usually, valuation takes place at various stages of any M&A. As you can see, there is a target identification, followed by negotiation and term sheet. There are then post-diligence adjustments to be made. There are certain transaction structuring and closures, post-transaction formalities, and then followed by exit. So that is how a M&A acquisition or a M&A restructuring usually would look like. The valuation would be done at various stages, starting from the target identification to the very last, that is exit. On the target valuation identification, we would have to do a very brief overview valuation to understand the pricing at which the company is being acquired at, followed by any negotiation and term sheet that are to be done. The third stage comes the diligence stage, where after diligence, if any opinion is there of in financial DD or tax DD or legal DD, there are certain adjustments to be made in the valuation. It could be both plus or minus, but that really impacts the fair market value of the company. Once the DD is done, the transaction and structuring are closed, we have to do valuation from the taxation and regulatory point of view, whether it is income tax law or Companies Act law, or any purchase price allocation that we have to do. Post-transaction, we have to do any compliance or any financial purposes, and followed by a exit valuation. So when it comes to an exit planning, a valuation typically comprises of two stages. There are two types of valuation: preliminary and complete. As who's the investor or the acquirer would want to exit at the right value. So we would have to understand how the company has to be valued, and the cycle again starts from the very beginning. There are certain issues and challenges that we face while doing valuation in any M&A transaction or restructuring. A few of them I've tried to list it down. It's not an exhaustive list. However, let's say accounting. Whenever there is any M&A transaction, whether merger, demerger, there are lots of different accounting for different entities, which are to be either merged together or segregated. There are factors affecting the jurisdiction as well. I mean, jurisdiction not only when it comes to India as a geographic area, but also globally. There are different regulations, settlement mechanism, taxation structure, and which impact a sort of the final value while doing the valuation. The deal structure for the transaction, probably the nature of transaction really has a very key role in doing the valuation, whether it's a merger or a demerger, slump sale, or any intangible valuation that has to be done because of it, or any disinvestments. sort of. There are certain times exotic instruments or complicated instruments like optionally convertible, differential voting rights, which had to be adjusted in while doing evaluation. There are certain times SEBI guidelines that we have to follow, methodologies across the SEBI guidelines, whether it is for takeover, preferential, direct or indirect listing, open offer, or IPO, let's say the reverse book building. Uh, Even the premium and discount, which is basically the goodwill value that has to be agreed on in the M&A aspect for calculating and deriving the fair value of the company. I would like to really put here a case study. It's of Reliance Industries. Although Manoj sir and the team earlier have given various case studies earlier as well, just to put in the numbers to that fact of Reliance Industries back in 2006. Although the demerger was for different reasons altogether, but if you'd ask me, as it was said by Manoj sir, was that whenever a company is demerged, as you can see here in the case of RIL and Reliance Capital, the total market capital pre-demerger actually was in the range of 1,27,900 crores. Post mergers, it was demerged into 4 entities as listed out here. The total market cap of the demerged entity post demerger rose to 1,51,800 crores. There was an incremental market cap of around 24,000 crores, and if I may talk in percentage terms, the wealth creation was of 20%. There could be numerous reasons for this incremental market cap and the wealth creation that was done because of the demerger. There was a proper focus on the core business of that respective company. There were certain tax benefits. The management becomes very much responsible towards keeping their focus on the costing, the expenses, the revenue of that respective core business, which leads to certain synergies. So I wouldn't say that this is not the case always, that every time you demerge a company and there would be increase in wealth, but most of the times it happens that in case of a demerger, we do see a lot of wealth creation in the in market. To talk about a few regulatory aspects of M&A transaction, we have to take into consideration the SEBI regulations, the Income Tax Law, or Companies Act. So SEBI takeover code, if you would ask me, get triggered when the shares of the listed company gets transferred beyond a threshold limit. It can also lead to a change in control, thus requiring an exit opportunity be given to the public shareholders. And for this purpose, the determination of the price of the shares has to be done and a valuation is required. So valuation is done for different shares of category, whether it's a frequently traded share or an infrequently traded share, has different methodologies given to it. In case of income tax, we have to do valuation whether it is a case of issue of share or transfer of share. So if you'd ask me, when an owner of a shares in a company transfers the shares to any person, he's required to pay capital gain tax on the difference between the sales considerations that is received by him and the cost of acquiring such share. It is very important that we check the sales consideration that he receives from the buyer, which should be at least equal or more than the fair market value, which is defined under Rule 11 UA. So that is where issue of share or transfer of share is required under Rule 11 UA of Section 56 of Income Tax Law. In Companies Act also, we require valuation report in respect of the shares and the property of all assets, whether tangible, intangible, movable, immovable, by a registered valuer. That is in case of a merger. There are other aspects also of regulatory where we do require valuation. Probably we can connect later on to discuss in more detail on how that happens. But that is all from my side. Thank you, everyone.
Okay, thank you, Sanchit, for giving a very lucid presentation on this. Friends, as you are aware, these are the all side from the consultant. That how the merger, why the merger, all these aspects are there. But the most important thing is, because we give one aspect, but there is another aspects of the promoter side, company's professional side. When they are planning something, what is there in mind, what industry wants to do. Like Manoj was telling, why to do leaning out, why to do merger, why to do demerger. But what are the aspects and what are the problems the promoters are facing and the companies are facing? Let's talk to our friend Rajiv Chaube, who has done various restructuring. He has worked in various big listed companies, top Sensex companies. Listen to his point of view that what is the issue which they are facing. Over to you, Rajiv.
Thanks, Pawanji, and thanks, corporate professional, for giving this opportunity. And M&A is, one such subject which is always very, very exciting, because in a life of a professional, there are very, I would say, the lucky ones who gets an opportunity to work in a, M&A kind of experience. Fortunately, I have been part of few. And while I speak also, we are currently, it is public announcement that we are working on some other M&A transaction. So I think I have the privilege of hearing to the previous speakers. So let me put some perspective, why M&A from a corporate or a promoter or a management perspective. I think the first and foremost is that if you really want to grow business, there are two ways of doing. One is the organic way, where you set up new capacities, new plants. And that obviously, in India, it takes a lot of time, because I'm talking from a manufacturing, and let me take my current industry, cement. So first you have to go and take a mining lease under auction, because now leases are only granted under auctions. You have to go for a bidding. Then once you get the mining lease, you have to go and acquire land for the mining lease. Then you have to set up a cement plant, and then you have to hire manpower. So typically it takes minimum 5 to, I'm saying on an average, 5 to plus years to set up a cement plant, a greenfield project. And it's while you decide today that there is some amount of growth opportunity in the market is really good, by the time you may put up the plant, the market scenario would have changed. So when you really want to grow, when the market is good, one of the ways is to go through the inorganic route. And when we say inorganic, it is basically, it can be either through mergers, or it can take the form of acquisition or consolidation. And the most common is, I would say, acquisition, where somebody who want to exit in the business for various reasons, not interested, or there may be stress in terms of other reasons. Or somebody wants to exit. So M&A or acquisitions give a very good opportunity. And before, I currently work for Dalmia, and these are all my personal views. Before joining Dalmia, I was part of Wholesale India, and I was heading ACC and Ambuja. I will take this example. So ACC and Ambuja, where Wholesale India was the second largest cement player after Ultratech. And Adani wanted to enter cement sector, and they acquired these two companies, and the deal got announced in 15th of May, and I think end of August it got closed, mid of September. So Adani, by acquisition of these two companies, ACC and Ambuja, straight away became the second largest cement player in the country. To become the second largest under the organic route have definitely taken a lot of time to set up so many plants. And it's not only plant. If you put up the plant, you need to create the market, the brand, the channel, and it takes years to reach second or first or whatever. So I think giving that perspective which Pawanji was telling, I think it gives you growth opportunity. That can be one. The second can be synergy. So let's take this previous example of Adani. So Adani is a big conglomerate, and they are into various businesses, including real estate. So this cement acquisition can also be very, very strategic. And I'm taking this as a case study because if you acquired a cement business, while you can sell cement, there is a lot of consumption within the group itself in real estate, and they are also into port, infrastructure, roads. So there is a lot of internal consumption for that. And, you can have better synergies when you do some acquisition. And synergies can be also, for example, let's take, some other company, for example, a steel company. The steel company has to have a iron ore. So a steel company can go and acquire an iron ore mining business to have backward integration. They can have forward integration also. They can go and acquire some company which is into special, kind of steel, which actually is used for automobile. Steel has also, different kinds of steels are there. So they can go and acquire a stainless steel company to diversify it from industrial steel to other stainless steel which has different uses. So it also can lead to diversification. Sometimes you also do acquisitions to improve your supply chain. So for example, again coming back to the Adani example, suppose they are into port. If they acquire a company in logistics, so logistics company, because port and logistics can also give you a very good synergy where you can give the customer, apart from the import export, you can also give them logistic support in terms of transporting the goods which are imported till to the end of the consumer wherever he wants the good. So that is one aspect. Then sometimes people do mergers and acquisition also from an economies of scale. In cement, again, I'll give you one example that Ultratech today is the number one cement player in terms of volume. But if we go some 10-15 years ago, they were not number one. But how they have grown, they have done a lot of acquisitions. They acquired some assets of JP Group, then they acquired Binani, then they they also got Century as part of the family settlement. So now it is a 120 million ton, cement. So now their size is so big that suppose if they want to do procurement for any raw material, or they whatever want to do in cement, their size and scale is very big. Even with less number of power, they can run more plant. So suppose if you are 10 million, you need X number of people. You want to become 10 to 20, you don't need to double your people, in terms of especially management, technical and support staff. So that it also leads to kind of many times to economies of scale. It also helps you to increase its market share. Taking the Ultratech example, I think they have become very big pan India. They are virtually present in every state. My current organization, going by the recent announcement which we did, we were not present in central India. And when I central India, it is basically UP and MP market. So to enter this area, there was this JP asset which was they wanted to exit because they have debt and they want to repay certain debts. So this opportunity came and we looked into saying that this is a very good opportunity for the company. While we were trying to set up our own plants, it takes time. So this allows the company to enter a very important market of central India. Then mergers and acquisition also gives you access to talent. So sometimes when suppose you acquire a new company, you get so much and especially if it's a very good company, you'll get a lot of talent. Generally it's very difficult to get good talent and it takes a lot of efforts to build the talent. So acquisition can also bring good talent which the existing company can use for further growth, diversification. That is one aspect. And sometimes it also helps you to diversify risk. Here I will take the example of my one previous organization, Vedanta. So Vedanta started as a cable manufacturing company. The most key component of cable was copper. And I am talking about way back in 89, 90. So when liberalization was announced in 91 and copper was allowed in private sector, they set up a copper smelter. So they diversified to backward integration to produce copper rods and copper cathode. So basically you get rods, from the rods you draw wire to make cables. today Vedanta if you talk of cables, hardly people know that Vedanta is also into cable through its group company called Sterlite, Transmission. Sorry, Sterlite Technology Limited. So from copper, which was a backward integration, they then diversified to aluminum, zinc, then iron ore, and then, even oil and gas. So today Vedanta has a portfolio of assets, which includes copper, aluminum, iron ore, mining, steel, oil and gas. So, and this commodity business is linked to the London Metal Exchange, with the prices keeps on, fluctuating. So when you have a basket of asset, what basically you are doing is you are basically reducing the risk of being dependent on a single commodity. You have multiple commodities. So assuming today, let's say aluminum is not doing well, but oil is doing very well. So overall, your portfolio gets diversified, and it de-risks the business. One more aspect which comes to my mind is also the tax benefit. Sometimes you may acquire a company which is loss making. You get a lot of unabsorbed depreciation and losses, and if you are a profit making company, you can use those losses to reduce your tax liabilities. So these are some of the typical reasons which comes to my mind as far as why we do an M&A. And from a general counsel perspective and a company secretary perspective, I think I'll just try and touch that how typically the process starts, and I think that this will give to maybe many young professionals. I think the earlier speakers have touched upon various aspects. So typically it starts with either a non-binding or a binding. It all depends upon the acquirer and the seller, that what kind of offer they are willing, term sheet they are going to. This basically, the term sheet will have what are the assets, what is the kind of economic value they are assigning, which is actually subject to adjustment after the due diligence is over. Because suppose you are selling something, so I say I should get a price of 100, and you say that, okay, Mr. Rajiv, I will give you 100, but let me understand whether it is, there are certain issues, problems, liabilities. As you know, company, everything is not reflected in the balance sheet. Sometimes there may be litigation, there may be some dark spot in terms of markets. There are so many issues because in an organization. So basically, after the binding or non-binding offer, you get into a due diligence process, which typically involves the legal due diligence, which is basically litigation, license, permit, approvals. Then a finance DD in terms of whatever inventory, books, cash, all those things. Then a tax DD, in terms of what are the tax implication which can have, whether GST is paid, not paid, being showed paid. Then typically, if it is into a natural resource or a cement DD, if I may say cement company, it will also involve mining, whether you have the mining leases or not, valid, not renewed. Then you get into, basically environment clearances are there or not, mining, what do you call, plan is approved or not. Then it also extends to lands and real estate. What land you have to engage a lawyer to do a DD in terms of the title deeds. And then real estate, and when I'm saying if the company is having offices and stuff like that, so that also needs to be kind of due diligence needs to be done, because there may be issue in terms of title deeds. Then it goes to employment and HR, where you basically check how many employees are there, what are the kind of wages you are paying, whether there is a industrial dispute, whether there is a long-term settlement with the employees. Then it goes to a technical DD, where the technical people go and check the plant and machinery, what kind of plant is there, whether operating, not operating, when the shutdown was done, when major breakdown happened. Because I think it's like, you are buying a company, you need to know in and out of the company. Then it leads to sales and marketing, what kind of dealers you have, what kind of arrangement have, what kind of market share is there, what kind of branding is there. Because when you are buying a company, you need to prepare yourself. Then it goes to once the DD process is over, typically we engage law firms to do the DD, and obviously tax. The law firms is for the legal DD, and tax and finance firm for tax aspect, and then all these consultants will give you a report highlighting some of the risk. Then there is a negotiation which is reflected in the definitive agreement. Depending upon what kind of M&A deals we are doing, it can be in the form of a share purchase agreement. So there may be, basically there are, we call it as CP and CS. CP is condition precedent. For example, if I am buying a company where there is a joint venture partner, so the partner who is not selling also has to agree, because there are sometimes, right of first refusal and stuff like that. So, and if there is a regulator which is involved, say, for example, if you are buying an oil and gas company, you may require the approval of Director General of Hydrocarbons. Or if it is somebody was mentioning about a NBFC, you may require RBI approval. So all these will be kind of CPs, and then there will be certain conditions subsequent which needs to be cleared, which reflected in the definitive agreement. So once those all CPs are cleared, then you go into the closing, and then at closing, once all the CPs are kind of tick marked, then you pay the consideration. And depending, suppose if you are doing a slum sale, so suppose a company is having 10 plant and it is selling 2 plants to me. So then typically it will be a slum sale, because those identified asset will be sold to me on a going concern basis through a business transfer agreement. We call it as commonly known as a BTA. But if the entire company is being sold, then it will be a share purchase agreement. So depending upon the type of M&A we are doing, the way it is structured, and then there are also aspects of structuring. Sometimes you have to also engage consultants to do a structuring, right structuring from a tax point of view. And then I think once you take over the asset, I think in my view, one of the most key elements is integration. How do you integrate? Because every company is a kind of has different ways and style of working, different management style, philosophies, value system. So I think it's very important. It's like when we marry, when we marry our, say, sisters or daughters, it goes to a new family. Now it all depends how the daughter is behaving with her in-laws, and how in-laws are welcoming the daughter, my daughter or anybody's daughter. I think the success lies when both the parties reciprocate. So similarly, in a merger and amalgamation, I think as part of integration, people integration is very, very important, because employees will start comparing, last company was like this, how is the new management, are they welcoming, are they hostile? And then obviously it will lead to other integration in terms of sales, in terms of policies, in terms of different other aspects. I want to, if I have time, Pawanji, I would also like to add a few more things. So I have seen a lot of M&A, and many of them have been successful. But let me tell you, when the management prepares for a M&A, they actually do an internal calculation. Okay, this is the entire enterprise value I'm paying. This is the kind of turnaround plan or growth plan. This is the kind of money I'm paying. This is the kind of debt I am taking. This is the kind of interest payment. So a lot of assumption goes into taking a decision to buy an asset. And obviously, depending upon the financial position of the company, either you may have do it through internal accruals, or typically it is done in a mix of debt and equity. If you take a debt, there are interest liabilities. So there are a lot of risk involved in M&A, because things may go right, may not go right. So suppose I'll take one more example of my previous company, Vedanta. So Vedanta was essentially into ferrous and non-ferrous metal. And I think somewhere in 2012 or 12 or 13, I don't recall, Vedanta acquired K in India, which was into oil and gas. Oil that time was at $110. and within 2 to 3 years, it actually fell to $40. So your entire assumption of the acquisition was completely where it went haywire. And then because of that, the group actually went into little bit of stress in terms of managing high debt. So M&A are also at the same time very attractive, very good for growth, but at the same time they are also risky, because you do an M&A thinking, it depends upon what is the situation, the macro and microeconomics after the deal is done, how markets behave, how successfully you are able to integrate, how successfully you are able to implement those plans which you have prepared on paper. I think, and then there are a lot of, I would say, post M&A activities which we professional as company secretaries and legal have to do, in terms of getting title deeds transferred, getting so many license approval permits changed from X company to Y company. So it doesn't stop at closing, but there are a lot of post closing activities, and I think we need to also keep an eye on that. I'll stop here and I'll be glad to take any questions.
Thank you very much. Thank you, Rajiv. You have nicely pointed out the other side of the story. And the best part is that what you are planning. Now time to question answer, because I have received various questions during the program or after the program. So before the program. So I will start these questions. So I just want to cover various aspects. So Manoj, I will start with you. What is the status of funding of M&A in India, and why government is reluctant to give funding to M&A? Because this is a growth aspect.
So typically,
this also, yeah.
Yeah, so I think RBI does not permit acquisition funding with respect to shares or securities of a company. So that is that law is there, because they don't want these assets are not so secured. There are risks associated with it. Hence, banks are not supposed to lend directly for acquisition of any listed or unlisted companies' shares. However, business or asset purchase, they are ready to finance. Similarly, for acquisition of shares and securities, there are NBFCs or other structured investor lenders who can provide the funding. So that the facility is available, but not directly. So not directly from the banks.
Rajiv, you can add why the banks are not funding.
I think, see, as Manoj has already touched upon, for share acquisition, I think this is an RBI policy. So it has to be taken at a policy. It's basically has to be taken with RBI, that why they don't promote or encourage share acquisition, funding for share acquisition, because it is seen as maybe as a kind of risky proposition, because what is the kind of value, then banker will have to get into value, why this value, and they will also have to be part of the DD. Why are you giving this value, and why not X, why not Y? But I think if my own submission is that if the net worth or the financial position of the company is good, and if can be backed by some kind of guarantee from the promoters, or some kind of securitization of the funding which is being done, I think I don't see a risk.
Rajiv, the point is that Indian companies are not allowed, because I'm in India. My source is Indian banks.
Yes.
Foreign companies, they are coming with the deep pocket and supported by their foreign banks also, because they're
absolutely.
So how this is a correct strategy of government and RBI, which we have, government should change this, because today Indian companies are in this. I will ask next question, which is also hindering. So Manoj, why the government is not giving this permission?
Sir, only reason, as Rajiv sir has rightly said, is they want to de-risk the banking system. They believe that banking system is not so robust that they can secure the investment in shares and securities, because it is not directly any asset.
The Indian companies are in loss.
Big
So
size
in-
transactions can be structured through NBFCs or even overseas funding is available.
Cost
So
is high.
No, I'll give the most recent example of Adani acquiring ACC and Ambuja from Holcim, which is a
yes,
very almost, I think, $7 to $8 billion deal. And Adani could raise funds outside India
outside
for
India,
the
yes.
entire deal, but no Indian bank
No
was
Indian
willing
bank was
to.
financing, yes.
Okay.
So-
Now the another aspects.
Yeah.
I think Manoj is well aware of this thing. Suppose there is a listed company, and uh, that company wants to acquire a big other company. Now say example, the listed company value is 100, and the unlisted company value is 10,000.
Hmm.
I want to acquire. Earlier, I could have done this because I could give the convertible instrument equivalent to the 10,000 value. Okay. But now SEBI's law is that you have to take the value today, the convertible instrument, what will be the value in future? What is the total conversion?
Percentage.
That you have to decide today itself. So you can't take this type of company because that percentage is always higher. 10,000, 100 rupees company and 10,000 rupees company, that matching cannot take place. So earlier they were allowing convertible instrument. Now SEBI is saying you just give convertible instrument and finalize percentage today, which should be less than 75. So Manoj, what is the solution for this? Because people are following that they are issuing, because to follow this, I have a company of 100 rupees. I am buying at 10,000 rupees. So the difference I'm issuing preferential shares. And after that, sometime the preference shares I'm converting the right when the investor is coming to maintain the 75. Is it possible?
Convertible instruments are not possible, as SEBI is not. SEBI has very clear view that it is a way of backdoor listing to unlisted company. If unlisted company is much bigger in size than the listed company, then they should not. They are not allowed to reverse merge into a smaller listed company in such a circumstances. So they are very much adamant on this part. We have given several representations also, and we many of the other companies as well as Chamber of Commerce has given representation, but SEBI is not buzzing on that part. So they want minimum 25% public float to continue, and for that they don't want to take any risk. So this is one of the aspect, but this condition is relaxed in case of acquisition under IBC insolvency law, where the holding can go up to 95% right now. And
Okay.
then 3 years time is given to come back to 75% here.
Manoj, somebody is asking that you have mentioned the change of registered office or saving of stamp duty. So
Yeah.
can you just elaborate?
So there are, as we all know that since the judgment of HLL in 1989 in Supreme
Tomco
Court
case.
judgment, Balco matter, yeah. So since then it has been held by Supreme Court, and many of the cases, Lee Taka cases are also there. They have concluded that merger scheme, order of High Court approving the merger is an instrument and it is liable to be stamp duty. It is an instrument for stamp duty and it should be duly stamped. Then only this is a valid instrument. So since then, many of the states have amended their stamp law and put specific entries into their stamp law. And then based on that, a different rate of duty, stamp duty is applicable for merger amalgamation in various states. But there are states where there is no specific rate, and hence normal rate of conveyance is applicable to them. Like in Delhi Tower judgment is applicable, and hence 3% duty is applicable in Delhi on all merger amalgamation transactions. But there are states which are promoting M&A transaction, like in recently Haryana in 2018 budget have amended their stamp law. Now they are saying that in case of amalgamation or demerger of a company in Haryana, rate of duty is 1.5% of the value of immovable property, if any. So if there is no immovable property involved in merger amalgamation, then there is no stamp duty applicable in case of Haryana state. So if the registered office of the companies are in Haryana, they will pay only 1.5% on the value of the immovable property, that to a maximum cap of 7.5 crores, which is very, very nominal rate of duty. And in case there is no immovable property involved, like in Gurgaon, there are many of the companies which are IT sector, there are no immovable properties involved. In such cases, there is no duty at all. So it is very efficient way to shift or base your registered office in such states who are charging very low duty, and you can do the merger. Similarly, I think 1% and special rate is there in Gujarat. So those states are promoting industrialization or having businesses established in their state, and that advantage can be taken in
Okay.
case we can plan.
Manoj, can conversion from sole proprietor to private limited company?
Yes, under company law, there is no specific provision with respect to such conversion. But from income tax point, if we make conversion of a proprietorship into a company, or then it will be tax free if certain conditions are fulfilled. So basic thing is the purpose of the company should be to acquire the business of the sole proprietorship. The proprietor should get at least 51% equity in the company. And then that is condition of more than 50% shareholding of the sole proprietor should continue for at least 5 years. If these conditions are fulfilled, then there is no tax capital gain in the hands of the sole proprietor at the time of conversion of sole proprietorship into private limited company or private limited company.
Okay,
So that is possible.
Rajiv,
Yeah.
what is the different way to engaging into earnings management on part of acquirer before M&A deal?
What are the various ways of earning management?
Different ways of engaging into earnings management on part of acquirer before an M&A deal.
And what does he mean by
I
earning?
think whoever is asked question is not clear. You just write clear answer. Okay.
Earning management is not clear because before a M&A deal, you can't enter into any kind of, if it is earning call or investor call, you can't actually enter into a, before the M&A, but after M&A, definitely you can, generally investors have a lot of cases. What are the contours of the deal? What will happen? How things will pan out, which, obviously management can, explain.
Okay.
Sir, I just want to add in this question. I was just searching about the question which someone has asked. So this is a concept which is majorly done in European countries. And by this concept in India, you can say that in stock deals, specifically in stock deals, prior to entering into M&A transaction, there are probabilities of increasing or achieving the targets of that target entity before consummating the transaction. So this is some sort of transaction, some sort of stock transaction whereby you can get the targets achieved of the target company before acquiring that company. So that is something which I got. So we can clarify later on this.
Okay.
Yeah.
On conversion of charitable trust of Section 8 company, if there is a movable property in the name of trust, what will be the tax impact on stamp duty in Maharashtra? I think these are some specific questions.
Yes,
Manoj,
we have to go deep into it. So
specific. Can LLP merger into private company?
no, that is not allowed. Two LLPs can merge into each other, or two private companies can be, but not one LLP and one company.
Partnership firm also?
Yes, earlier the law was there was a provision that joint stock companies, which is any partnership having 8 or more partners, would be considered to be a joint stock company and could have been merged into company under the 1956 Act. But that specific law is not available here. We can take advantage of under section 366 of the Companies Act and try such kind of merger of partnership into a company.
Okay,
but it is a difficult challenge because there are different views of NCLTs.
Okay, is it possible for public listed limited company which is closely held to convert to LLP directly?
Yes, it is possible. Okay. Subject to consent of all the shareholders.
Okay. How the goodwill be treated in valuation of M&A deal, Rajiv?
This is an accounting question. Sorry, I'm not.
You can tell.
So, sir, valuation is always a subjective thing. If you think that the goodwill of or brand of a company which is getting acquired or merged is very high, or it can have a benefit to the transferee or acquirer company, then certainly they will like to value it, and valuation is done on various methods like super profit, capitalization of super profit, or other methods. So there are perception based method also. If you think that this brand is removed from the market, then there will be certain advantage, you can pay premium for that. So those are negotiation part.
Okay.
There are methods to value goodwill also.
Can a Section 25 charitable company not registered with income tax under Section 12 be merged with a charitable trust registered under Section 112?
Trust merger there is no provision
Not
of
allowed.
merger for the trust.
Okay. Okay. Now, conversion from sole prop, this is okay. This is we have done. There's one question: do the shares of unlisted private companies get auto listed in case of reverse merger?
There is no provision of automatic merger or automatic listing of a company, but in normal circumstances, if a listed company, listed company is merging into unlisted company, or a
Yes.
listed company is vertically split, then to make the public shareholder or investors having liquidity in their stock, SEBI law provides an opportunity to get those companies listed, subject to compliance of certain rules and regulations. So we have to seek specific exemption from SEBI, and they will grant the exemption subject to certain condition, and then that company can be listed.
Okay, Manoj, in the meantime, you read this first question of Madhulika Mishra. Then I'll come. Ruchika, can you just tell me, before Ruchika, Rajiv, cross-border merger, what is the status? Because you are handling all these.
Yes, cross-border mergers, it is possible. It is done. So depending upon whether these are two foreign companies or one Indian company and one foreign company, it is very much possible. The law of both the jurisdiction has to be followed, and it's very much possible.
Okay, Manoj, have you read this first question?
Yes, the question is, I think, more about the process of issuance of shares in case of amalgamation. So it is saying that the value of the transfer company is X, and against that transferring company need to issue 3 lakh shares. So what will be the treatment in the hands of the shareholders? So as typically the shareholders would get the shares replaced. Their company A share would get replaced by company B share, and their cost of acquisition would continue to be the same as they have, and their holding period would also be the same as they were holding in case of earlier transferred company. So that is the change. And what will be the accounting treatment? So it is very much clear that the company is issuing shares for consideration other than cash. So they will book the assets which is being transferred as part of the scheme as their assets, and against that they will issue certain shares. If there is a difference, that will be adjusted into capital reserve. That is the accounting treatment under in the AS 14 or Ind AS 103 of the accounting standards.
Okay, Ruchika, just tell me, previously what was happening, you can take over a company, listed company, and merge it. So through merger, you are taking over a company that was allowed. But now, what is the route?
It is still available, sir. There is no restriction. There is no restriction of direct merger of two companies. It has happened in case of Vodafone and Idea. It has happened in many other cases also. So it is possible.
What are the basic points SEBI is looking for?
So I think so they will look into the fact that the combined management, consolidated management, what will be the role of the shareholders or promoters of the erstwhile listed company, whether there will be joint control or single control, and they will look into obviously the fact that consolidated holding 75% limit of promoters holding should not breach. So these conditions, if getting fulfilled, they will allow the merger.
Okay. So now, can stamp duty is liable on the order of merger in which removable and movable property are transferred to transferee company?
Yes, stamp duty is payable in almost all states.
Okay.
It is only on immovable, not on movable. I think.
In Delhi or in many of the states, even movable, it is paid on the consideration. So it covers both sides.
Right.
Okay. Can a listed company demerge into two companies and one demerged company can be unlisted?
It can be done theoretically, but in most of the cases, SEBI object to it, how you will give exit to the public shareholders of the company which is remaining unlisted.
So I will give the delisting as per the rule of delisting. I will give
Yes, Companies Act also provides, in case the scheme is not providing for listing of the demerged entity, then exit opportunity should be given as per the SEBI law. SEBI has not brought any specific law how to value that, or whether there will be reverse book building for delisting process. So we have to see what kind of how to justify the fair price for exit. If that is possible, then the company can remain unlisted.
Okay. How do we issue shares from private limited company if the net worth of sole proprietorship is 2 crore?
Sorry, how do we?
I think this is Mr. Shah. You can ask this consolidated question because you have 2-3 questions. You can ask us separately. We'll give you reply.
If the net worth of the sole proprietors is 2 crore, then the private company should issue shares worth 2 crore. And that should not be less than 51%, more than 50% of the paid up capital of the company. That is the condition if you want to take advantage of the tax exemption under 47.
Yes. Okay. And do the shares of in order to give effect to the conglomerate reverse merger between two distinct business, does rationale of the merger scheme hold any importance with respect to NCLT approval, since the common ground between the two companies are nothing but mere?
Yes, it is possible. Merger amalgamation commonality of object may not be a reason. There can be a company which are vertically related to each other. There can be backward or forward integration. There can be marketing integration, like Rajiv sir was talking. If it is a port company which is acquiring logistic company, it can be very much synergy benefits. There can be many synergy benefit, and company can keep both the company businesses together in one entity. So there are companies which are having multiple businesses, or there are companies which are having single business. Everything is possible.
Okay, an Indian company, say a company has made ODI overseas in the elsewise regime. Another company B is wholly owned subsidiary of foreign holding company. Can the companies A and B merge, since this will establish an ODI FDI structure in India?
Yes, it is possible. There is a specific law now. Cross-border merger is also possible. So you can merge your company into holding company, or holding company into subsidiary company in India. That is possible. RBI has given a specific exemption. Only those sectors which are prohibited for FDI or ODI is not allowed to be merged.
Okay, 19(2)(b). Just Manoj, give some clue on 19(2)(b) listing of listed company where you are demerging two companies and going for listing. You have to follow 19(2)(b). So what are the basic points SEBI is looking for giving approval?
So the Securities Contract Regulation Rules 19(2)(b) requires any company to be listed only on bringing out an IPO. But there is a specific provision under Rule 19, Subregulation 7, Subrule 7, which says that if certain conditions as prescribed by SEBI are fulfilled, then the company can be listed without IPO. So those are the basic conditions which has been notified by SEBI from time to time. And right now, Consolidated Master Circular is there of November 21, which prescribes conditionalities for seeking exemption. So the condition, one of the major condition is that it should be a division of a listed company, or it is a merger of a listed company into unlisted company. This is the primary condition. Besides that, in the post-merge scenario, the holding of the public holding is not less than 25% in normal circumstances, and in case the consolidated value post on listing is more than 1,600 crore, then the initial holding of those public shareholders of the listed company should be 10%, and which need to be enhanced to 25% within 3 years. So these are the basic conditions. Besides that, all other things, they will look into the valuation. There should not be any undue benefit to the promoters. So all those things are there, then it is possible.
Okay, Manoj, when we do merger or demerger or various aspects, taking over loss-making company. So in your opinion, in this segment, what are the cash in the shape of various losses various type of, like you mentioned, authorized capital, you merge authorized capital. So what are the assets available? What are the money available indirectly?
Yeah,
Money-
so if we are talking about merger of stressed company or distressed company, there can be various kinds of advantages. Like there can be carry forward of losses, which is the business loss. Business loss is available for 8 years. So in case we are doing the reverse merger or merger of a profit making unlisted non-profit making company into a profit making company, then that 8-year period would again start from the date of merger. So that advantage is there. Then if there are unabsorbed depreciation, that depreciation would continue for lifetime for subject to condition that you are not disposing of the assets of the merged entity for within a period of 5 years. So those conditions have been getting fulfilled. You can carry that unabsorbed depreciation for unlimited period. Then as I have discussed, there can be authorized capital for which fee has been paid to MCA. That authorized capital can be consolidated into the another company and can be used for issuance of fresh shares, either in part of the scheme or otherwise. Then there can be let's say GST benefits are there. You have GST credit. Those credits can also be taken over and utilized by the company. So these are the basic things. Besides that, internal structuring assets which you are acquiring at a lower price, those benefits are also there. So that will continue.
Okay. There is a question. Can a Section 8 company invest in equity, and what are the company compliances or implication?
Section 8 company is not for profit organization, so they can invest into any company. Either surplus asset can be invested into, let's say, good companies, so that the benefits of those can be put again for the purpose of the object for which it is created. Otherwise, generally, it is not allowed to invest into the group company or somewhere else. They should invest only for the purpose of their harnessing their object for which they have been created or they have been given the license.
Sir, somebody is asking the example of the net worth of sole proprietorship is 200 crore. How do we issue shares worth 200 crore? Because then the authorized capital will need to be 400 crore and there will be a huge stamp duty. So I think
yes, if you want to take advantage of the tax, you have to fulfill the conditions. Obviously, you have to value the company's share, unlisted company's share. So if you are creating a new company, obviously its value will be par value only. So if you have to pay 200 crore, you have to issue 20 crore shares of ₹10 each. Obviously, there will be a need for creating a huge stamp authorized capital.
Or they can't issue in premium.
For newly formed company, justification of premium is very difficult. So under income tax, issuing of shares other than for the startups at a higher premium is also taxable event. So they have to be very careful about that. The fair value will be the maximum value.
So Mr. Shah, if your answer is clear, otherwise you can contact us separately. We'll give you answer. Okay. Throw some light on Adani funding, getting funding outside.
So I think Rajiv sir has discussed if you have operations overseas, or you can create a holding company or acquire a company outside India, then banks, there are foreign banks who are very much willing to fund you. So they will take collateral of the shares which is being acquired in the takeover. They may also look into the assets of the target company and take place or security after, let's say, 60 days more time may be given. After that, you have to create charge over those assets to secure their assets. So that is called. That is also a possibility. So it is possible if you can create external structure.
Okay, Manoj, now it's a rapid round, very short. Recently, you have done one case in which wholly owned subsidiary and holding company merger. We have seen that meeting of shareholders and creditor were dispensed with the NCLT even when no written consent is obtained. Can this be placed in similar all cases?
Yes, there are. We have used similar cases of the past. there were high court judgments in which it was told that if the holding company is merging into subsidiaries consolidating into holding company, then there is no risk because the assets are already, the 100% equity is already there, and hence there is no need for further consent. And based on that, we have taken this.
Stamp law is required to stamp duty shall be paid on M&A transaction. Are there any exemption or exemption and exceptions?
There are normally there is no exemption. There is a past circular in Delhi, like or in some other states also, where there is exemption from stamp duty if the merger is between holding company and wholly owned subsidiary or 90% subsidiary. So, but that is also under challenge. So it is subject matter of litigation.
Okay. In case of transfer of demerged entity from the demerged company to the resultant company, are there any tax benefit? Would such transaction attract applicability of capital gain tax?
In case of merger, there is no capital gain tax immediately. There is a specific pass-through under section 47 of the income tax. So there is no immediate tax impact.
Acha. Okay, whether it is mandatory to transfer all the asset in the scheme of at fair value?
No, it is not mandatory in case there are two methods of merger, two methods of accounting of a merger. One is under, if you are talking about old scenario, that is accounting standard 14, there was two methods, pooling of interest and purchase method. So in case of pooling of interest, all assets and liabilities are transferred at their carrying book value and no revaluation is done. In case of purchase method, mandatorily you have to value right now in the under new India's scenario all the assets and take them on their fair value, and difference may be adjusted in the reserve or goodwill.
Okay. Do you think if the company is going concern, why we have applied NAV method?
If company is going concern, why to apply NAV methods? So there is no, everything depends upon the industry, business, their scenario. So if there are surplus assets, they can be valued, they should be valued at their fair value. So in like Sanchit was talking, if it is a real estate company, it is better to take the fair value of all the assets and make their sum total to determine the fair value. So that can be one of the method. But for non-physical asset company, it is not applicable at all.
In case of conversion of private firm to private partnership firm to private limited, stamp duty would come into picture.
It can. It depends upon the state to state.
Okay. Can you throw some light of brand and intangible valuation in normal course?
There are methods prescribed for valuation of brands, and we have to basically, the value of brand is the difference between the business without that brand or with that brand. So difference, super profit is the value of the brand. So there are different methods to determine that.
Okay. Can we claim benefit of section 72 during consolidation of group companies in all cases?
Not in all cases. 72A is the provision which starts with the provision that it should be industrial undertaking. So manufacturing business should be there to take advantage of 72A in normal circumstances. There are infrastructure company, power companies, and the government PSUs. They are allowed to carry.
Okay. Okay. So I think thank you all. Manoj, I just want to ask you last question as we are asking. What is your suggestion to SEBI and Corporate Affairs Ministry to make the vibrant M&A structure? No doubt, this particular section of Companies Act where you can do anything, okay? And any structure you can come out, anything you can do in the name of restructuring. But that's why the SEBI and the company law always coming out some protection. So what is your suggestion? You, Ruchika, you also suggest?
Sir, two very important aspect is the timeline. M&A transactions are very critical for economy and for the growth of the organization. So there should be exact specific timeline for every regulators to consider or give their comments. So presently we see a lot of time is taken at stock exchange and SEBI level, as well as then again NCLT level. Other regulators also seek a lot of time. So that need to be reduced in some manner. Then obviously a lot of checklists and SOPs have been created, but they may be strengthened and may be applied fully. One hurdle we had discussed, like in practical scenario, the 75% threshold for promoters holding, or 25% threshold for public shareholder is not very difficult to achieve in all circumstances. Even if the presently promoters holding is, let's say, 60% also, and they want to acquire a similar size of company through merger route, they are not possible. This is not possible. Even smaller companies may not be acquired if the holding is growing beyond 75%. So those conditions may be relaxed subject to certain restrictions and protections which may be built, which may be suggested by organization SEBI. So those things are very critical. Besides that, it is NCLT benches are not there. The difficulties are there. Then there are regulators within the MCA also. They are applying different rules. So one RD is asking certain other things, other is asking different things. There should be SOP for all the regulators, all the regulators department within the department, so that they can take similar stance all over India. Then stamp duty confusions are also there. So there should be a common, maybe common law across the country, and which may be applied, and maybe stamp duty may be distributed among the respective states as per their asset in that state. So those can be make the M&A transaction very fast and easier for corporates.
Okay, Ruchika, you can tell us something because quickly some issues on where M&A can be a effective tool.
Sir, broadly, Manoj sir has covered all the nuances critically of each of the aspect, but I would like to say we need to understand two things behind the M&A transaction. One is the business mindset of the promoters and the management, and the other is the regulatory's mindset of protection of shareholders, creditors, and other interests, which are there in the transaction. So both these interests need to be synced. There cannot be a lot of delay in regulatory approval so that the promoters loses interest in acquiring. So that has to be synced, and timelines should be there to get the things done on a faster pace. As we see in lot of global scenarios, the transactions happens really fast, and India is presently lacking in it, which we feel after discussing with promoters. So that is one of the area.
Okay. So Ruchika, takeover regulation is changing. So I'll cover this part. So thank you very much, all my learned speakers, that we have covered, and we have tried to give answer of all the questions. In case, because some questions are not clear, so they can write email to us. We will reply to you. And in case you require some specific detailed one, you can call us. We will help you. So friends, now we are closing this session. But before this, as you are aware that we are doing webinar on every Friday. So there is a very interesting topic connected to today's topic, that SEBI is coming out the overhauling of the takeover regulation. That's why they formed a committee, and they are asking, advising SEBI of various issues relating to substantial acquisition of shares and takeover, including measures of facilitating ease of doing business. So there are so many problems in takeover, present law, practical problems. So SEBI wants to discuss that how to ease out. Second is the review the extent possible provision of takeover regulation in light of past judicial pronouncement and various formal, informal guidance issues SEBI till date. Because so many interpretation is taken by the court, and the so many informal guidance interpreted by SEBI, they want to include all these things in the law. To advise SEBI on measures required, if any, in the legal framework for simplification of takeover regulation, and strengthen the extent takeover regulation by adopting appropriate global practices. So they want to understand that what are the practices is not possible, not implementing, and some issues. And matter including internal inputs of the department pertaining to substantial acquisition of share and takeover. So this is the SEBI's committee's mandate, and the SEBI wants to discuss these issues. So next webinar we are doing on this topic, and we have invited learned people, those who are day and night doing work in the capital market relating to takeover. Lalit Dua, Pawan Sara, Prabodh Jain, Arun Palivar, and then Arun Malhotra. So these are the people who are the part and parcel of the system, and they will suggest something on these aspects, that how the changes will take place, what are the suggestions SEBI should adopt, and what are the market practices they are following. So from our side, Manoj and Ruchika will be there, and other market participants will be there, and we will ask them that what is their suggestion on these lines, which we can refer it to SEBI. So please join us next Friday on 23rd, and discuss this issue. If you have any issue, if you have any takeover you have done, if you are facing any compliance issue, you have any issue of disclosure, you can write to us or you can ask question on that same day. We will discuss threadbare every aspect, that what are the changes say we should bring out when they are finalizing the new this, but they are doing overhauling of this law. So thank you very much all. Thank you all the delegates, those who have participated in last number. Thank you very much.
Thank you.